Hello and welcome to the Week in Markets. I'm Paul Durrans, Investment Director, and I'm delighted to be joined by Portfolio Manager Matt Henderson. Now, it's been a very busy week in markets, touching on inflation, economic activity and interest rates. I suppose the key event for markets this week was US inflation. Inflation's been on a downward trajectory, slightly bumpier this year. I suppose, Matt, if we start there, we had the March report on Wednesday. What did we learn from the report?
Yeah, so thanks, Paul. As you've mentioned, US inflation has been on this path of coming down, so disinflation, although we've reached this point where it's started to become stickier and we've started to hit some bumps in the road, and I think that's what this report has provided. So looking at both measures of core and headline inflation, they came in slightly higher than what the market had been expecting. So that's core inflation at 3.8, headline inflation at 3.5.
And if we think about the month-on-month numbers, that was 0.4% for both core and headline. You know, core inflation is stripping out energy and food prices, and it's the measure that the US Central Bank typically puts more weight on. If we think about the month-on-month readings of 0.4%, the momentum is trending upwards, isn't it? I suppose that's the slightly concerning point. It's moving away from their 2% inflation target. If we look at the individual components, we break down that basket, what stands out for you?
Yeah, so when we were in this period of inflation falling, this disinflationary period, what we saw was headline inflation was leading core inflation. I guess what we're seeing at the moment is the reverse of that, where we're seeing core inflation move higher and move above headline inflation. And I think one of the distinctions we've been making as an investment team is just how that inflation's been driven. So if we cast our minds back to 2022 and look at that type of inflation, that was all a shock and driven by the supply side. So we're seeing inflation move higher because of supply chains following COVID, and also higher commodity prices following the Russian invasion of Ukraine. Whereas what we're seeing at the minute is that inflation is moving higher, but we've got growth coming alongside it. So in 2022, no growth associated with that inflation, whereas in this inflation regime, we are actually seeing strong demand from US consumers.
And that's the real positive. Stronger demand keeps the economy going, and if that's really coming through in the services almost completely when we look at the baskets, and that's the likes of shelter, medical costs, transportation. I suppose if we think about interest rates, expectations, big focus for markets, they have been coming in terms of interest rate cuts. They have been falling this year. Is that continuing?
Yeah, so that's continued. So if we think about the start of the year market, we're in that disinflation regime. Market was thinking that we might get up to 6 cuts from the Federal Reserve, so 1.5%. Given, as we've mentioned, stronger inflation, but also stronger growth in the US economy, they've moved back. So markets thinking about 1.5 cuts, so slightly less than 0.5% worth of cuts from the Federal Reserve.
That's been quite a big change, and markets have taken that pretty well this year. If you think about the strength that we've seen in equity markets in the first quarter, I suppose what was the initial market reaction following the inflation report this week?
Yeah, so I think the obvious place to start is just talking about fixed income, given we've been talking about interest rates cuts. So what we've seen within US Treasuries is that they actually moved higher. So yields moved higher on the day by 20 basis points, which is quite a significant move in a single day's worth of trading. That then moved through into equities. We saw those weaker on the day by about 1.5%, depending on what index you look at. But then also important to mention how currencies moved. US dollar stronger across the board and against other global currencies.
Excellent. I think that's a really interesting point, because whilst the US dollar is stronger against the pound was weaker, that was actually a boost for the FTSE 100 UK equities because of the translation effects, and really emphasises the importance of global investing diversification, because whilst US equities were weaker, as were bonds, UK equities were actually up on the day. So if we've focused on the US, the largest economy in the world. If we think about the second largest economy in the world, China, they had their inflation report. I suppose, how would you contrast the two?
Yeah, so polar opposites really, Paul. US, we're talking about inflation being stickier, moving higher. We're actually seeing the opposite in China. Disinflation continues, but actually starting to move lower. So to give you some perspective, that US headline number was 3.5% for inflation. China, it's only 0.1%. You mentioned earlier the shorter term US numbers being 0.4%. What we're actually seeing in China is negative 1%. So China is moving into a deflation regime.
Yeah. So a much weaker economic backdrop for China, whereas the US economy continues to be resilient, robust growth. So very different dynamics there. If we move to Europe, they had their latest interest rate decision on Thursday, the European Central Bank. Expectations were for no change to interest rates. Was that the case?
Yeah, so that was the case. Markets had been expecting it, so no change in interest rates in Europe. I think markets more concerned with the guidance or comments that come out from the central bank following it. And what they were talking about was this theme of disinflation in Europe persisting and actually thinking that they can get more towards their 2% inflation target on a sustainable basis. Why is that? Well, they're continuing to see the trends in price inflation come through, but now they're also starting to see wage inflation soften too. So they think that that can lead them to that 2% target on a sustainable basis.
Good. So a stronger nod from the ECB that interest rates will be cut this quarter, but still a little bit uncertainty given the strength of services inflation and the impact that currency weakness could have on inflation going forward. But for now, interest rate cuts expected. Okay, so let's finish off with the UK. We had latest economic data this morning with GDP figures. We had a technical recession in the second half of last year, but we've seen things start to improve. What were the details, Matt?
Yeah, so the report this morning showed that February's GDP was up 0.1%, and importantly for us as well is that the January numbers got revised higher too. So moving away from that technical recession that you talked about in last year, I think the other positive thing to mention is that given these two GDP prints that we've had, we're now back to the level we were before that technical recession. So we've recovered any of that ground that was lost during that technical recession. So for this quarter, we're on track to do 0.4%, which is higher than what the Bank of England actually forecasted. And if we look at the parts of the report that made up GDP, we're seeing strength within manufacturing, strength within services, a little bit of weakness within construction. That was mainly due to poor weather conditions, but all in all, a positive report for the UK.
Excellent. So despite all the doom and gloom that we read in the papers about the UK, economic data is actually improving. Excellent. Well, thank you, Matt, and thank you for watching. We'll see you next week.